In this tutorial, I would like to explain you about JKH White stock. I'll just copy that and paste that and write stock besides it. And you can see the name here, and you can see that if I buy the stock right now, I have to pay $143.19 per stock. And the market cap is in billions. This means it's a big size firm, and dividend yield is 1.12%. Dividend yield, if a company pays dividend yield, that's a positive sign, because that means that after paying their loans, creditors, their liabilities, they still have money left. And that extra money is paid to shareholders as dividends. So if a company is able to generate extra money after paying their costs and everything, they still have money left, that means they're financially strong. So even if the dividend is very less, it's 1.12%, even if it's less, but still it means that they are financially strong. So it's a positive sign. And I want to see when was it born. So founded 1976, or you can just go to Wikipedia, you will find this box, and in the box you can see founded 1976, 43 years ago. And you can see that I'll just copy this whole thing name from Google, and I will paste that right indeed besides it and review, and I'll click here, or and I can see 275 reviews, and I can see 3.5 star, which is brilliant. And I want to see the reviews in Glassdoor, and I'll click here, and I can see 577 reviews, and it's 3.5 star, which is brilliant. And you can just read through the reviews yourself, and you can just see what employees have to say about it. And I'll go to Yahoo Finance. I want to see the key executives of this firm, and I will just paste the name here. That's the one. And profile, and sector is industrials, industry is business services, and 6,307 employees. And there are 5 executives, 4 have salaries shown, one doesn't have, one don't have any shown. You can just search this in another website, and to see why it's not shown, because the more information we have, the better, and the more trust we are able to build. So that's better. And let's have a look in Justia patents and see if it has any patents. And you just paste here, and I will just click enter. And so what I'm interested in is assignee or applicant. I'm not interested in inventor, because inventor are people who have invented but they don't have full rights. Only assignee or applicant people have full rights to the patent. So I want to search the name of the firm. That's not the name, that's not the name. So I'll just paste the name here and make sure that the name matches the assignee. Or I think as far as I can see, I can't see any patent. No, they don't have any patent. I can't find any patent of this firm, because the more patents a firm has, the more stronger it is, the more moat it has, competitive edge it has. It's a very strong firm, but this firm doesn't have any patent. So let's see macro trend, which is a brilliant website for ratios. Click price ratios and price book ratio, and paste in the symbol, and I'll just click here. And this website, you have to be a bit patient with it, because it takes time to load. So but it's a brilliant website. And I'll explain briefly. Price book ratio, if it's less than 1, that means that the stock is very cheap, it's undervalued, it's at bargain and discount, it's ideal to buy that time. If it's 1, that means that the stock is you're buying the stock at the real worth, so it's not expensive. If it's more than 1, that means that the stock is expensive. The higher the number goes, the more expensive it gets. So that's the point. And it's just loading. And please let me know if I'm going too quick in this video, or if you have any questions for me, please leave in the comment section or in the discussion of YouTube. So you can just I will just explain you briefly while that is loading. You can just go to um, the discussion and just type in any comments you have, and you just ask as many questions as you want, or you can just ask beneath the videos, my videos, and ask any questions that you want. So okay, it's loaded. So this one I just want to explain that so we are looking for price book ratio. Right now it's 7.72, which means if somebody buys the stock right now, they'll be paying 7 times, nearly 8 times more money. So it's 8 times more expensive. So it is expensive. But in 2018, it was 9 times more expensive. September 2018. If you just see vertically up, you can see if somebody bought in September 2018, they paid 159 or $160 to buy something that was only $17 worth. So they bought something that was only $17, but they paid $160. So they bought it 9 times more expensive. Stock was very expensive. Right now, it's 7.72 times more expensive. And the cheapest it was, I think, in 2009 March, when it was 1.98, nearly 2 times more expensive. So you can see vertically up that people who bought that time paid $14 to buy something that was $7. So it was twice as much in 2009 March. Right now, it's 7 times, nearly 8 times more expensive. So you might wait a little bit. It's up to you to decide if you want to wait. You never know, it might go up even in price or it might come down. So it's up to you to decide. And let's have a look at other ratios, and I want to look at current ratio. If the current ratio is less than 1, that means that it's a dangerous stock. If the current ratio is 1.5 or more than that, that means the stock is very safe. So we just want to have a look. Let it load, and please ask as many questions as you want, and you can just comment on the discussion section as well. And please let me know if you want me to make any video that you think you're stuck on, or you want me to cover any topic. I would love to do that. So you can see that the current ratio is, we are looking for 1.5 or more than that. It's less than 1.5, it's a risky stock. So let's see the previous trends. Has it ever been 1.5 or more than that? Mm, in 2013, it's 1.5 for a while, and then it's just fluctuating. So I would say it's a risky stock in terms of current ratio because it has never been 1.5 or more than that consistently. So it's a risky stock. So let's look at debt equity ratio. We are looking at 0.5 or less than that. So we are looking at zero point 0.5 or less than that. Right now it's less than 0.5. Let's look at consistency. We have data, actually, yeah. So let's see if it has ever been above zero point 0.5. No, never. So it has consistently been below zero point 0.5, so which means it's a very safe stock in terms of debt equity. So let's see return on equity. So we are looking at 8% or more than that. So we are looking at 8% or more than that. It is more than 8%, and if I just see previously, it's more than 8%. And since we have data 2005 up till now, it's always above 8%, which is brilliant.